that affects condominiums, particularly within the coast, over 4 stories, that requires mandatory funding of reserves, mandatory structural repairs, and has accelerated the recertification process where you have to do a lot of these big projects and expensive work. So that's just one bucket there.
Yeah.
But as no one has a crystal ball to predict the economy, we also have all these headwinds that we already had these intense new legislation passed, and now we've got rapidly rising insurance costs. I mean, a lot of condominium associations right now, their annual budgets are increasing dramatically because of how expensive insurance is. And we've got this interest rate environment where we've got interest rates that are double, nearly triple of what they were just 2 years ago. So I think the condominium regulation in the new legislation, it was very well intended, but I don't think it works that well given all of the headwinds. Yeah, and that's also, that's obviously a big part of the story. In addition to what I can go on and on about this, you have the top of the market that continues to perform so well.
Yeah.
So it's everyone asks me, what's going on with the real estate market, the condo market? I'm like, well, which segment of the market do you want to talk about?
Tale of two markets, yeah, 100%. So I agree with everything that you just said as far as describing what's going on. I think at the in my opinion, right? So I come from Wall Street. I grew up on Wall Street in my career, and so I talk numbers, interest rates, markets all the time. And I think with the thing that people are forgetting. And we're in the thick of budget season. That's all anybody's talking about right now in the condo association world, right? I think everyone's forgetting, though, that the variables you just described really lead up to everything else being more expensive. Not just insurance, but everything else, right? So if your property values have gone through the roof, right? Well, it costs more to rebuild those properties just in general, whether you're an association or a homeowner, unit owner, whatever. With interest rates through the roof, in general, right? If you think about it from an insurance perspective, that causes balance sheets at the insurer level, right, to actually decrease because they're losing money on their investment side, which drives the entire business. There's all these things. You called it, I think, you described it very well. It's the perfect storm. Unfortunately, right now, we are in the perfect storm. And then you have this pendulum swing of all the amendments, all the legislative changes that have happened in the past 2 years, that now, as of June 1st, basically, if you think about, when everything was done, June 1st of this year moving forward into June 1 of 2025, there's a lot of stuff that these associations have to comply with and have to get everything in a row. They have to budget for all these increased costs and pay for that stuff somehow. So that's the setup, and what's that leading to? What are you guys seeing?
So we're seeing a lot of stress in the market, and within the market, I would say sort of like the middle segment. I can't speak to maybe like Class C or Class D buildings, but in the middle market, you have insurance rates that are already exploding the annual budget, causing 30+% increases for many associations.
Yeah.
And then what I sort of see as a problem on the horizon is, a year or two from now, when you have these mandatory reserves that have to be funded that are going to be expensive, insurance probably is not coming down anytime soon. And then you have these huge structural and capital improvement projects that need to be done. You might have people that say, well, I want to sell. But with interest rates where they are right now, and presumably where they're going to be for at least another year or so, it's a tough market to sell into right now. I'm not excited about getting an 8% mortgage and purchasing a property, and I think a lot of people share that sentiment. So it's a tough market to sell into. So then, you say, okay, well, we have these huge capital needs for our association. Let's finance it. So we'll pay everything now, and we'll finance with a bank. We'll get a loan to finance the special assessment.
Yeah.
But guess what?
Yeah.
Interest rates are way higher on those loans now, so the cost of capital is much more expensive. And then some banks, they're saying, hey, you've got too much work to do. You don't have enough insurance. You're not fully insured. I don't like where your insurance is for the building. And so banks are not thrilled about lending to all these condominium associations. So you have an association that people are having a tough time selling out. They're not liquid enough to fund their assessment need.
And these assessments we're talking about are like 30, 40, 50, 100K sometimes, depending on where you live.
Oh yeah,
right?
yeah.
So it's not chump change here. We're talking tens of thousands of dollars.
Yeah, someone asked me the other day, they're like, what's like a big assessment you're seeing, like $10,000 per unit? I was like, no, not even close.
Yeah.
I'm seeing 10x that.
Yeah. It's so I think unless you understand that, you don't realize the gravity of what we're talking about in most instances, right? So that's interesting. So the financing has now become an issue. It's kind of like three legs to the stool. So we'll call it insurance was the first leg. That was the kind of big killer in the beginning, especially the past 2 years where you're budgeting from all the associations we represent. Every conversation is saying, what are you budgeting? 20% increase, and it ends up being 50, 60, sometimes double the premium the next year. And so that was the first year they got caught a little bit. So what they do the next year? Okay, so we're going to budget 40, 50%, and then they got caught again. And so it's hard to manage a business that way. And I think people forget that the business of running a condo association as a board member, right? It's really driving a business. Like it's not just it's emotionally charged because of the environment.
It's because it's where you live. It's different. It becomes very personal.
But it is a business.
Certainly.
At the end of the day, it is a business, and if you can't get financing to be liquid in the business in general, in your business lines, and you also need cash to fix the business, it's a perfect storm. You're kind of caught in the middle. And again, but now the result of that is these zombie condos that you're talking about, these condo terminations potentially happening, because it really, tale of two markets. It affects the folks that maybe are on a fixed income, they're older, they bought their unit in the building 40, 50 years ago, it was $200,000.
Yeah.
And now today it's $2 million, right? The numbers are way off balance.
Yeah, so that's the sort of, we're talking a little doom and gloom, but there's a lot of bright spots in the market as well. I mean, we have Shore Club in Miami Beach coming on record-breaking prices. Yeah. Robert A.M. Stern, one of the top architects out of New York. Just incredible product coming to Miami Beach. Yeah. We have Four Seasons and Surf Club. They're selling upwards of $5,000 a square foot. Price per square foot that people never heard of in South Florida.
Yeah, that's wild, yeah.
So it really is a tale of multiple markets. And that multiple markets is also sort of driving this interest that you alluded to with condominium terminations. So you're starting to see a larger uptick in demand from developers that want these prime sites. Yeah. We've built out South Florida.
Well, the pro formas aren't penciling out.
Yeah.
So let's talk about buying a building now, right? And coming in and buying an association and renovating it. Maybe that'll pencil out. That's what we're seeing, I think you're talking about, right?
Yeah, definitely. Yeah. People are looking at, we've basically built out South Florida, or there's barely any prime development sites, particularly waterfront. And then you have these older condominiums that are on unbelievable land. Yeah. Miami Beach, downtown Miami, Sunny Isles.
The views, the ocean, everything, yeah.
All over. Brickell Key. And so you're seeing a huge demand for these waterfront sites where sometimes it makes sense to do a bulk offer and buy out the condominium, all the owners, knock the building down and redevelop a new product.
Yeah. So interesting. And I think the obstacle there, though, is still the financing, if I'm not mistaken.
Oh, certainly.
The rates are not very good, obviously. And then to pencil that out over time, which is actually a great segue into the third part, which is the pipeline. The pipeline in Florida is very full still. And that product, we'll call it, right, has to be delivered, whether it's a condo termination and it's just a renovation, or if it's a total teardown and rebuild. But the pipeline is extremely full, so that pushes pressure on the other side too. Right. Because if this stuff is delivered, but it's not sold quick enough, they don't get to the end of the CPM and roll the loans over, right?
Yep.
It's the same difference, right?
It's tough. It's tough, but the Florida and South Florida community, we got to keep driving demand. We got to be a pro-business state. I think our the low taxes help significantly. There's been huge improvement in schools and larger companies relocating here. So as much as South Florida used to be, I'll have my condo there, second place there, I think we've moved past that. And particularly with some of the new-to-market leases you're seeing in Brickell and other areas, these are not just kind of, we're going to open a Miami office. These are new-to-market companies that are coming and saying, we want to be in Miami as our primary office, which I think is incredible.
Yeah, it's happening all like my wife and I moved down from New York last year in April, and I can tell you since the pandemic, not a single one of our friends, maybe a couple here too, but not a single one of our friends really live in the city anymore. Everyone moved out, right? Yep. And most of the time, most of the folks that we know are moving down here. I mean, I joke, we moved down here, a man's barber is his best friend at the end of the day, right? But my barber actually moved down here before my wife and I did. And it's just like, all these little things start to add up when you see that. And our friends are down here. I have groups that I used to work with on Wall Street that moved their entire offices down here. I mean, that's not an easy thing. I mean, Ken Griffiths moved his entire world down here. Messi comes to town, all of a sudden the whole world comes to town now. FIFA's here. Everybody's here, right? And this is the this is the place. Miami, Coral Gables,
Yeah, that's what I think. It's amazing. I mean, I've been living here since 2005. I'm a Midwestern guy. I moved down here, and people were, oh, Miami, kind of looking at me cross-eyed a little bit. But, we've grown up so much, and even with all the headwinds that we're facing, we still have the incredible tailwind of demand.
Yeah.
We've got demand, which a lot of cities don't have, a lot of Northeast cities don't have.
Yeah.
I won't even comment on the West Coast.
Yeah. Well, it's different, right? Let's talk about high taxes and no demand.
Yeah.
Where no taxes and high demand. Obviously a factor of us moving down here was I didn't have to pay New York City taxes anymore, which was awesome.
Yeah, certainly we're seeing that. In a lot of the residential transactions we do, we're seeing that a lot. Where it's just a pretty simple calculation for someone to say, if I move down to Florida, even with higher interest rates on the mortgage, the amount they're saving each year on a significant income is, it's considerable.
Now, property taxes are a little bit higher now, I would say, at this part of the cycle, the last 2 or 3 years. That's just a factor of also, home prices, values going up in general and things like that. But there's a balance, though. You're right. I mean, there is a balance, and you have to figure that out. So, okay, good. So let's wrap all that up and talk about kind of that's kind of the setup for the landscape. That's what you're saying. That's what you're dealing with a lot. How does this kind of flesh out? How does this reflect in 2024? What does it look like at the end of next year, do you think?
So I don't have a crystal ball, but I think we're going to have higher interest rates for at least a year. So that's not going to bring, sort of the relief some people are hoping to the real estate market in general.
Yeah.
But like I said, we still have this strong tailwind of demand. We still have a lot of people and companies that want to move to South Florida and are moving to South Florida.
Yeah.
So I think, some of the doom and gloom and some of the dark clouds we talk about that are on the horizon, they do have, some counterbalancing factors. But I think we're going to see the problems in the condominium world accelerate for the most part. And, hopefully we'll get some private market solutions on insurance. I wish I could give you a 5-second solution on that one, but I'm not smart enough to figure that out. And I hope that eventually the legislature will relax some of these requirements because there's just too many headwinds right now. There's too many economic hardships to really make all of that work during this time.
Yeah, and unfortunately that's how sometimes legislation kind of pushes the envelope a little bit forward. They have to go a certain distance to then kind of tie it back. So in this instance, I would agree. Some of that stuff has to be pulled back a little bit, and it's going to be by feel, unfortunately. Yeah. But I think talking about the insurance side of it, I think the only thing that hasn't been addressed, which is unbelievable to me, and it's actually we had a conversation with Rep. Lopez, Vicky Lopez, last week. Citizens was there. We had our friends from Falcon there, one of our favorite engineers. But the question came up where no one really wanted to step up and answer it, which was, okay, we have all these milestones, these CERS, these requirements for reserves we have to meet. We have these recertification processes that some of us are going through 30, 40, 50 years now, 60 years, whatever. But how, if we do all this work, if we do all this stuff, we spend all this money, and insurance premiums go up and deductibles go even higher from, now we're saying wind deductibles from 5% of TIV to 10%, which is crazy because that's a whole other conversation about whether or not you can self-insure a community association in Florida, which you can't. But you're seeing that the pendulum is swung and nothing is pulling it back. But if you do all this work, right? And you can agree or not, but if you do all this work at these associations, your associations puts the time in. They spend hundreds of thousands, if not millions of dollars to bring it up to code, bring it up to these milestones, these recertification demands, and they fund their reserves. So they're in compliance now.
Yep.
Why wouldn't they pay less insurance? The building's more insurable at that point, in my opinion, from a structural standpoint. They have the reserves necessary, even though you can't self-insure in the state of Florida. Why would the insurance company not look at that and say, okay, well, because you did all this, because you're 7 months ahead, right, you have your reserves, you have all this stuff done, why is there no consideration for that? And I brought that point up in the discussion, and it was like deer in headlights. Everyone just looked at me like, oh, okay, well, yeah, we didn't think about that. But there should be some kind of trigger, in my opinion.
I think there needs to be considerable weight given to that in the underwriting, that now the building is safer.
Right.
The building is, you've beefed up all these systems. You've done the work. Certainly the underwriting reflects if your building has a bad roof and you don't have storm shutters and all these things. You're like, hey, the number's going to come back bad. So I think there's got to be some weight given to that, considerable weight given to that, and the underwriting. And then I don't know if eventually from Tallahassee, we have some relaxation on the standards of how much insurance these buildings have to have. Because
Great
we're
question.
going to have to look at,
Great question.
at a certain point, it's going to become unfeasible for these buildings to be fully insured, the full replacement cost.
Well, let's pick. That's a great. That came up. That was a big
Yeah,
part of that
and I've
conversation.
been saying this. It's not the most
Yeah.
PC thing to say, but I think there's going to have to be a very direct discussion eventually of like, do we really need to have the building fully insured?
Well, what would be the point? That's what I always say. What's the point of that, right? Think about that. So you have a $300 million property. You're insured for $300 million. At what point would that association ever require $300 million? There's only
Right.
two ways. Either a fire takes out the entire building, or you have an absolute catastrophe, whether it's Surfside style, that happens
Right.
again, or a hurricane comes through. I mean, you'd have to knock the entire building down.
Right, and
You're
then
never going to get there.
And so
right?
we have a Cat 5 hurricane come, and
Yeah.
we have unfathomable tragedy with these
Right.
buildings. But then guess what? Then the insurance companies go bankrupt, and they're not
Right.
paying out these
So
claims anyways. And then it's like,
it's
why
a
did we
pseudo
go through
argument.
10 years of pain?
Right.
So yeah, I've been banging the drum that maybe we need to adjust the insurance requirements, which people, it sounds controversial to say at first when they say, well, you have a Surfside, so we need to be fully insured. But it's like, as you said, like let's actually play this out to its logical conclusion, taking
right.
the emotion out of it, and where does that lead us?
So I think what they're doing, which they'll never admit, I'm sure, but I think what we're seeing is they're taking the it's a when you look at flood insurance, for example, right? They're taking the intent of a flood insurance policy, where basically if you're going to get policy limits on a flood insurance policy, that means your property has to come off the slab, right? Single family home or whatever it is, right? That's from a flood perspective, that might happen because if there's 18 feet of water, like we saw in Hurricane Ian, and you have a home that's raised and elevated, and all of a sudden 18 feet of water comes through, that water is heavy enough to push things off of their stilts, off of the slab. And that would make sense in that scenario. I'm being very specific. But these towers that we're talking about, that we represent, that you represent, they're not going to come off the slab. Like, it's not going to happen. Could there be amazing and incredible damage? Of course. But a $300 million tower is never going to see a claim that's $300 million unless it's totally gone.
And it's one of these things where maybe you adjust the law so it requires significant unit owner participation.
Sure.
To say, yes, we do agree, we're voting in favor of insuring the building up to X percent as opposed to 100%, because we've seen the numbers, we've seen what it's going to do to our budget, we understand the risk and reward.
Yeah, but insurance companies are happy getting a premium that's based on a $300 million valuation, I'm sure, right? So you have two or three towers, you have 2 or 3 towers, you have a masters association, so you have 4 associations there, and the value of the property is obviously front and center, and of course they're going to say, let's insure up to the full value. They're running their risk metrics as well, right? Yep. So their actuaries are telling them yes at that point. So again, I'm biased, fully admit that, obviously, but that's another discussion. So okay, so you think rates will be higher into next year? You think these issues will? I don't know if they'll they'll ramp up quickly and we'll have a whole slew of these condo termination deals. I think we're going to see them more often, but seeing a handful of them in a quarter is way more than probably the past 3, 4, 5 years, 10 years combined, I would imagine, right? Yeah. So it is more prevalent, or we're going to see it more often, I would agree. But what happens if there is no relief? What happens if this continues for another year in your mind? What do these associations do? So they've met their requirements now, they've put all these reserves, the value of the properties go up again, and so they have to get another appraisal and all that. I mean,
it's going to become very expensive to live in a bunch of these condominiums.
As it already is,
It already is, and it's going to become much more expensive to live in these condominiums. Yeah. And then, unfortunately, that's going to turn over sort of who can do it and what buildings succeed and don't. And it's going to be a tough time.
Yeah, so hopefully that can be managed a little bit better. Maybe we get prepped a little bit from a legislative perspective for stuff like that. Again, maybe there's some relief in some of those bills. And the upcoming session is going to be very interesting, to say the least. I would imagine.
Yeah, I'm participating in a panel with a couple of our representatives later this month, and I will definitely be trying to grab their ear for some of our issues.
Tell them what's going on. You got to let them know. So all right, good. Well, I think those are the most. I think our conversation is from an impact standpoint. Those are the most highly debated, highly talked about topics. We had a whole president's dinner that you and I did with some other folks over at Sexy Fish, that we talked about all these things, right? And again, insurance is always top of the list there, but these condo terminations are the end result of some of these bad policies that are going to affect. I don't know if you saw this the other day, there was an article that basically said that none of this stuff has actually helped at all. And they went through with data and showed that how much worse it is since these changes went into effect for the condo association world, the community association world in Florida, which is eye-opening. To say at least, like nothing's been effective so far. And while we're talking doom and gloom here, someone's got to step in at some point and make some changes.
I completely agree.
Yeah. Okay, awesome. Well, thank you for joining us today. I think that was a very deep discussion without getting to the rest of it here. If an association or a homeowner or whomever, developer, GC, whomever, if they want to get in touch with you, they call Haber, they call you. How do you want them to reach out?
Call me, cell phone 616-633-3747.
There you go.
Email is probably the best way to get a hold of me. It's my first initial D, then my last name Podein @haber.law. Little tricky there, but we like to be a little different. And then this year, I'm much more active on social media. I was called out by our marketing team. They said, you're not doing enough. I said, all right, if there's one thing I'm good at is following directions. So
good.
Find me, David Podein, across all socials as well.
Awesome.
Not TikTok yet. I'm a little old for that, but who knows?
I don't do
never
the
say
TikTok
never.
Either. I don't do the TikTok.
If Matt starts, maybe I'll start.
Maybe we need to do a little dance, a little song, the whole thing, and we'll get famous. I don't know, influencer famous or something like that. So, thank you very much. Awesome talk. Again, if you guys want to get in touch with David, you can also look in the bottom of the caption. We'll have his information in there. Check out the website, give him a call, if you need his services, would like some advice and some counsel. Obviously, if you like today's episode, please like us, follow us, go on the different platforms. We're going to have clips, if not the whole entire video, especially on Instagram, Facebook, LinkedIn, of course, and then also on YouTube. So thank you again, sir. Great time. Appreciate it.
Thank you so much. And I want to say thank you to all the GlobalPro team members that helped put this together.
Thanks.
People haven't seen this, it's an unbelievable setup. I mean, I'm basically at 30 Rock right now. So I want to thank everyone at GlobalPro. This is beyond impressive. And as well as Haber Law, we had a bunch of people behind the scenes that helped put this together. And believe it or not, we don't just show up.
No. A lot of prep. But this is a natural conversation between him and I. We talk about this stuff, occasionally, very, very deeply, and we care a lot, and we're very passionate about our industry, obviously. So thank you again, sir. Thank you for joining us today. Please don't miss next week's episode. Again, always right here at the Nucleus Hub, the Griffin Studio. Next week, Thursday, and every other Thursday, 11 a.m., same place, same channel. See you then. Thank you very much.
Thank you.